The external environment had been very favorable for India up until last year. Now this year, with what we've seen, the rise in crude oil prices, the rupee has been depreciating. Foreign investors have pulled out a lot of money from India. Top all of this with also the fears of trade wars. Should we be bracing ourselves for a much tougher year?
On a relative basis, obviously oil is the main issue for India, right? Because as an oil importer, that's really weighing on the current account deficit, and that's not going to probably go away anytime soon necessarily. But India is in a much better position today than it was, let's say, in 2013 during the taper tantrum, to be able to weather some of these external factors. So foreign exchange reserves obviously are at an all-time high. They cover, any way you look at it, imports at a much more sustainable level. They cover external debt, short-term, etc., at a more sustainable level. And I would say, you look at the inflation metrics. Obviously, they improved quite dramatically since 2013 with the new inflation targeting framework, and there's a lot of credibility around that. So I would say things are better than they were in the past. India is more prepared to deal with external headwinds. But the Federal Reserve and interest rates globally are most likely going to rise as rates normalize. But India is also less vulnerable than some other countries in the sense that it doesn't have nearly as much foreign borrowing as well. And so the exposure to dollar strength is less acute for India than for other sovereigns.
Aditi, do you think we're better prepared than before, even though these external headwinds are really much worse than what we've seen in the recent past?
Well, certainly if you compare 2018 to 2013, I think India is in a much better position. Inflation is significantly lower than what it used to be. The current account deficit, even with the slippage that we're expecting in FY18 and FY19, the current account deficit is still expected to be around 2.5% of GDP, which is nowhere near the alarming levels that we had prior to 2013. Our forex reserves have gone up very significantly. We've seen a dip in the last couple of months from the all-time high. But our forex reserve cover to merchandise imports is closer to 10 months right now. Despite the fact that merchandise import bill has gone up a lot because of crude oil and other commodities. And this was around 7 months of cover in 2013. So even from that point of view, we are significantly better placed today than what we were in 2013. So the fears are there. Certainly it is a situation that we need to be watchful of, particularly in terms of are there adequate FII and FDI flows this year to really be able to counter the rise in the current account deficit. But overall, if the rupee does depreciate a little bit, it is something that should support our export competitiveness. So it's a bit of a mixed bag. We need to be watchful.
Recent statements from the Finance Ministry seem to indicate that there is a threat to meeting the fisc target this year. Last year for FY18 we met the 3.5% fiscal deficit target. For this year it's 3.3%, but there seems to be some pressure on it. Borrowing costs have increased. I think the bond yields have risen sharply over the last 1 year. Is that an area of concern for India? I mean, for a rating agency as well, will you be watching out for how this pans out?
Well, obviously, we will be watching. Our expectation is that the government is committed to achieving a 3.3% central government deficit target this year. There's obviously risks around that. I mean, on the revenue side, GST collections could slip from targets because it's really the first full year of implementation, and taxpayers are still getting used to compliance, and the system, the UA system, is getting rolled out, etc. However, the last 2 months have been rather encouraging in terms of what could transpire. I think with regards to oil, the pressure there is really on the excise tax and the possibility that could be adjusted. But again, the government seems committed to that. They benefited from the windfall in the past, but that is a risk. On the expenditure side, we don't know what the formula will be for the MSP in terms of its final format. And as you indicated, the pre-election spending could be a risk too. But what's most important to us really is the medium-term commitment to fiscal consolidation, and this the government
which has been pushed back to 2021 now.
Yes, but I think what's most important to consider is the fact that that target of a debt to GDP ratio didn't exist before, and to really codify that as something that's formalized is important and is material, particularly whether it's a few years out. Obviously, it would be preferable to have it earlier, but it also has to be achievable and credible.
Okay, Aditi, you think the 3.3% deficit target, we're on track to achieve it?
See, there are clearly a lot of risks. I mean, Bill has already talked about most of them. I'll add a couple. Last year was a great year for disinvestment. You know, it benefited from the ONGC-HPCL deal. This year, we're not quite sure whether there is going to be any big ticket disinvestment in the same manner, particularly after seeing the Air India results. So that is another area that we are concerned about. Telecom also, there could be some small slippages compared to the budget estimate based on our recent estimates. And even dividends and profits, you know, that was an area last year where we had quite a bit of shortfall in the dividend and profit numbers. So I think that's again something that we're going to be watching for. On the expenditure side, you know, one of the things that Bill has already mentioned most of the risks. I'll just add one more, bank recapitalization. Clearly this is an area that the government may need to address sooner rather than later. So we'll be watching for what kind of an announcement comes out from the government on that front.
$4.4 billion or so have gone out of India this year, and I think a bulk of it was in May alone. Now with what we're seeing with the Reserve Bank of India, say, hiking rates, starting that cycle, do you think that is something we'll be able to address? Is that an area of concern as well?
Well, you know, what seems to be a key important factor for foreign investors obviously is the currency and stability around the currency. And with global interest rates rising, again, as we talked about earlier, this is not just India, this is around the world.
Emerging markets also.
Exactly. So, you know, with the MPC decision yesterday, I mean, that keeps in line with the rate rises you see globally, and the focus is moving forward is neutral based on data. So I think I would expect an investor to be reassured with the commitment to inflation targeting and maintaining a stable monetary policy.
Okay. Aditi, you think 25 basis points done yesterday, how much more to go this year?
Monsoon, MSP and crude oil prices are going to be really important. Where do crude oil prices end up? Are they fully translated into domestic prices and our excise duties and VAT cut by the state governments or not? So a lot of moving parts to this picture, significant amount of lack of clarity at this point in time on how the balance of all of these risks will play out for the full year. I'm just going to offer one scenario, which is that if crude oil prices look like they're going to average $80 per barrel in FY19, then that itself could push up our headline CPI inflation by about 30 basis points on average for the full year. And in that scenario, certainly a second rate hike could be forthcoming, possibly in Q3 of FY19.
How do you view some of the recent reforms that have been undertaken by this government? I mean, starting from demonetization, the implementation of GST, RERA, which is a Real Estate Regulation Act, all of those changes now, and with the IBC also coming in. How do you view these reforms?
You know, the reforms, they all work together. The way that we look at it is a medium-term story in terms of building institutional strength, improving the economic and macroeconomic framework that over time will result in higher sustainable GDP growth and, importantly for India, higher revenue collections that will contribute to an improving debt dynamic. I think all of these things in some way can contribute to that. The other story obviously is the investment cycle and both building confidence in India as an investment destination as well as allowing banks to finance that investment from the supply side, and I think that the IBC in particular is very important and encouraging, and that now there's a resolution mechanism in place that over time should help address the twin balance sheet issue.
Okay, you know, India's GDP forecast as per the economic survey is between 7 to 7.5%. Now the government seems to be indicating it could be the lower end of that spectrum. What is your own reading of where India's growth is, trajectory would be like?
So originally we had 7.5% for this year. We recently adjusted that downward to 7.3, but we expect it to pick up again the following year to 7.5. Okay. And that really has to do mainly with the impact of oil on net exports.
The reason for the downward revision?
It's one of the key drivers for that, obviously, and the impact that could have on consumption as well. Okay, and next year you said you see a rebound? Picking back up to 7.5. Because of? On the back because we believe that this is going to be not a permanent feature, that ultimately the reforms that we discussed, for example, and we believe oil prices will stabilize most likely at a lower level than they are today, and those things together will eventually provide impetus for higher GDP growth. Aditi, what is ICRA's own forecast, and do you see the current growth mostly being led by the public spending rather than private capex really picking up?
So our forecast for FY19 is that we're going to see a shallow V-shaped recovery, and we're going to go back to a GDP growth rate of around 7.1% for this fiscal year. Okay. We expect it to be basically led by domestic consumption and government spending, and we hope that exports would pick up as well.
What will trigger the next rating upgrade action for India, or downgrade, either way?
Moving forward, it's a stable outlook, fundamentally. I mean, when you look at things, the peer group for India, India is kind of now at the bottom of the new range. We expect it to be several years for the reforms that we discussed earlier to take shape and to really contribute to strengthening of the credit profile. And the most important factor there is on the fiscal side of things, as we discussed, so bringing down that high debt to GDP ratio more in line with the median of the peer group, which is 50. The peer group basically is 50% of GDP versus about 70% for India. So there's a big gap there. There's room for significant improvement that would still keep the rating at the current level, but it would be slow over time, and that's what we expect to happen.
Last year we've seen a lot of issues crop up, whether it is asset quality peaking, not really peaking, but rising a lot. I don't know if it's peaked yet. Frauds that have come to light, corporate governance being questioned at some of the largest banks in India, the ICRA Bank Videocon case. All of that has cast a shadow of doubt. I mean, as far as investors are concerned, there's a loss of faith, so to speak, in the banking sector. What do you make of some of these developments, and what can be done to, revive the sector as a whole?
Sure. So, many of these developments, some of these are perhaps operational risks, and which could have been avoided if those risk controls were in place. But clearly those issues have meant that, especially for the public sector banks, the capital hole has increased further. On the other hand, private sector banks are also grappling with asset quality issues, but perhaps for them the capital issues are a bit less severe than the public sector banks. So now your question is what can be done to prevent these issues. I mean, I think one thing is the government already has a recapitalization plan in place. On the other hand, we think the private sector banks are okay on the capital front. If they want, they can also go out and raise capital from the markets, because perhaps their share prices are trading at much superior multiples compared to where the public sector banks trade right now.
Now, as we step into FY18, the first quarter is over. We've seen the last quarter's results where most of these public sector banks have reported losses. So are some of the private banks. How does this year look now? Do you think really now can we say that we've seen the worst of it?
In terms of asset quality, if you were to ask, then possibly we've seen the worst. The reason why I'm saying it is, optically reported gross NPA numbers may probably have been rising at a sharp pace last year, but one has been looking at the overall stressed assets in the banking system for some time. So there the jump has not really been material. And with the February circular, where most of the banks have had to recognize the assets by March, that's also resulted in Q4 possibly being the quarter where we've seen the worst gross NPLs in for a long time. It's practically the highest. At a system level, over 2.3 lakh crores have got classified as NPAs, and for the whole year we've had over 5 lakh crore of assets getting classified as NPA on a total stock of 10. We believe that this year the additions to NPA should be much lower. Last year, in terms of percentage, if you were to see, it was about 7% additions to NPLs, about 7% plus. This year the number should be in the vicinity of 3%. And if we were to add the fact that we do see some recoveries happening from the NCLT 1, NCLT 2, and mind you, these are large ticket transactions. So we've already had announcements on 2 of these transactions. So couple more, there would definitely be a scenario where you would see a reduction in the overall stock of NPAs by the end of this year.
Capital, of course, is a huge requirement, especially because of the rising bad loans. I mean, loan loss provisions have risen. What do you make of the recapitalization plan that was announced in October? The last few years, every time you've spoken, you said it was inadequate.
So when the capital plan, the recap plan, the government announced in October, and which is a large plan, 2.1 trillion. We thought the capital plan will be sufficient for the banks to tide over these issues. And capital plan has to be kept in context of two issues. One is the capital ratios the bank or the shareholder is targeting, which is the government, and the second thing is the provisioning needs of the banking system. Moving on from October to where we are now, the government did infuse a large proportion of it, and they did say that they will upfront large proportion of the capital, which they did. And where we are now, clearly some events that we discussed earlier were negative and were not anticipated. So this huge loss or the fraud at PNB or the sharp turn in bond market yields means that the bank's losses were much more than what were anticipated before. Yeah. And as such, the bank's profitability has been much worse than what we planned. Having said that, the budgeted amount, which is 650 billion rupees for this year, we still think that this can broadly achieve the minimum capital needs of the banking system, but will come at a cost of credit growth in the system.
Do you think the government has been miscalculating the capital requirement of the public sector banks? Because, as I said, I mean, every year it seems to fall short.
So this capital, the big plan that government put out in October, also envisaged that the banks would go out and raise 58,000 crore from the market.
But with the public sector banks profile, that's not really been an option.
So I think that's essentially what has changed right now.
Yeah.
When the capital plan was announced, the bank share prices actually rose 30 to 40% at that time in October.
Yeah.
And in December, we did see some of the banks go out and raise some capital as well. And I think going to what Karthik said, we also think that perhaps asset quality will gradually improve, or his headline numbers will come down. As balance sheet improve, the banks could have gone out and raised capital from the market. But where we are now in this year, the share prices are depressed. We don't think that this capital is readily available. So that is what is perhaps creating a difference in the assumptions right now. And the question is, will the government fill this hole by providing capital or not, which is what the banks were supposed to raise from the markets by themselves.
Okay. Karthik, will there be meaningful recovery this year for the banks?
It'll spill over to 2019. It's not going to be calendar 2018 looks difficult. You would definitely see some resolutions happen in the next 6 months.
Yeah.
The reason why I'm saying this is you already have the NCLT 1 accounts, 12 odd accounts, and then another 28 odd accounts in the NCLT 2, where if you strictly go by the time frame that has been put in place, you should see at least some resolutions of those. It's not going to be exactly time bound in all those cases. You would definitely see some delays. But what I'm trying to say is at least even some resolutions happen. So till now there have been, it got constituted last June, July. There would always be teething issues in the first couple of cases, how the transactions happen, how does it get closed. So once you have some sort of a track record, no doubt every transaction in IBCs is uniquely different, so you can't apply the same yardstick everywhere. But at least some smoothing of the systems, processes, timelines could help in seeing recoveries.
But how much of that 2 lakh crore do you think even from the first list can be recovered? So far we've only seen Bhushan Steel close meaningfully. Like Electro-Steel is still subject to the court's decision.
RBI had any case asked banks to increase the provision cover to 50% by March. Ignore the 1 quarter forbearance which they've got, but in otherwise they've had to make a provision of 50-odd%. So to the extent banks are able to recover anything over and above that, would be sort of a positive from their point of view.
What is the sense as we start this new financial year?
Okay, so overall, if you look at in terms of revenue growth and earnings, there has clearly been a distinct revival in most of the consumption-oriented sectors over the last 2 quarters. Going forward, while revenue growth is likely to continue to be fairly robust, at least that's our base case scenario at the present, earnings, there are question marks because of rising commodity prices as well as rising interest rates.
Capex revival has been somewhat modest, if not low, these past few years. Will that see a revival as well?
Capacity utilizations continue to stay low. As we understand, it's not yet at a stage where you require a lot of capacity expansion. Petrochemical India continues to import, so there is petrochemical capacity expansion as well. Oil and gas, huge importer. So we see upstream companies spending on capex. But if you exclude these 3 or 4 sectors, then you go into, let's say, auto, where there is revival in demand. Telecom, there is now intense competition. The operators are trying to expand and upgrade their network. So that also is keeping capex high. So if you exclude these large sectors, you come down to smaller sectors. Yes, the capacity utilization is low, and that's why you're not going to see too much of capex just yet.
A lot of the cement and steel companies featured in the NCLT cases that we've seen. So as more and more resolutions take place this year, do you see more consolidation happening in the industry?
Yes, steel, of course, there's going to be major consolidation, because already one we have seen, then the outcome of a few other big cases are awaited. Yeah, that is one sector we are going to see a lot of consolidation, and that definitely seems to be a positive for the industry as a whole. What
about telecom? Is there room for further consolidation here? Is there a need really for these players to consolidate, to solidify their positions?
So, as the consolidation stands today, you are looking at a picture where there are going to be 3 major players plus BSNL and MTNL. The 3 major players being Vodafone Idea, Airtel and Jio. Is there a scope for further consolidation? Very unlikely. Most of the markets we see in the telecom, you end up getting 2 to 3 players, at least with the size of India. I think 3-player market is something that can be sustained. So further scope for consolidation, unless there is any stress in these players, they run out of money or something, I don't think there is a scope for further consolidation without bankruptcies. The industry structure is sustainable at this level.